Most people think an economic collapse destroys wealth, but that's only half the truth. An economic collapse doesn't erase money. It moves it. Every single major crash in history, think 1929, 1973, created widespread fear for the masses and incredible fortunes for a select few. Today, we are going to pull back the curtain and talk about who actually gets rich when the economy collapses, how they do it, and why the same names seem to keep winning every single time. When an economy collapses, three things happen almost immediately. First, asset prices plummet. Stocks, real estate, everything goes on sale. Second, cash becomes extremely scarce. People and businesses are desperate for liquidity. And third, panic spreads faster than facts. This is where the game is won or lost. Most people react emotionally. The winners react strategically. Let's start with the first group who benefits. The people who control cash when everyone else needs it. During a collapse, cash is king. It becomes absolute power. Not because it's earning interest, but because everything else is on sale at a massive discount. When markets crash, people don't sell because they want to. They sell because they have to. They've lost their job. They're facing margin calls on their investments. They have debt payments they can't make. This is the exact moment when cash holders step in. Think back to 2008. While the world was panicking, hedge funds and private investors were buying up real estate at 30, 50, even 70% discounts. Or look at 2020. Investors who had cash on the sidelines bought stocks when everyone else was frozen in fear, only to see those stocks soar in the following months. The rule is incredibly simple. When everyone needs liquidity, the person who has it gets to set the price. This is exactly why the truly wealthy do stay fully invested when the market is at an all-time high. They keep dry powder cash reserves ready to deploy, not for safety, but for opportunity. Next up, a group that might surprise you, banks and financial institutions. Now, this might sound controversial, but history is crystal clear on this point. Banks almost never lose during a major collapse. They either get bailed out by the government, or they get to buy assets for pennies on the dollar. When loans default, banks don't just lose money on paper. They take ownership of real, tangible things. They foreclose on homes. They seize businesses. They acquire land. During crashes, banks convert bad loans into real, hard assets, and they often do it with the backing of government guarantees. And when the central banks inevitably step in to save the economy, they flood the system with liquidity and drop interest rates to near zero. And guess who's first in line to access all that cheap money? The banks. It's a classic pattern. Losses are socialized, spread across the taxpayers, while the gains remain private, kept by the institutions. This isn't a conspiracy theory. It's a well-documented, repeating pattern. Now, let's talk about the third group, the ultra-wealthy, the billionaires. Here's something most people completely misunderstand. Billionaires don't keep their wealth in a giant vault of cash. They keep it in ownership. They own stocks in major corporations. They own private companies. They own vast amounts of land and valuable intellectual property. So when the markets crash, their net worth on paper might drop temporarily, but their control and their power actually increase. Why? Because they have the capital to buy what others can no longer afford to hold. In 2008, billionaires were buying up stakes in failing banks. In 2020, they were buying up companies in tech, logistics, and critical infrastructure. Crashes accelerate consolidation. The small players are forced to exit the game. The big players absorb their market share. The rich do want to panic during a downturn because their financial survival doesn't depend on a monthly paycheck. It depends on long-term ownership of productive assets. This brings us to our fourth group, the specialists, private equity and hedge funds. For these firms, an economic collapse isn't a disaster. It's a business model. Private equity funds literally sit and wait for recessions to hit. Why? Because distressed companies sell for incredibly cheap prices. A healthy business that was worth $100 million during a period of economic growth might be forced to sell for just $30 million during a panic. Private equity swoops in, buys the company, aggressively cuts costs, restructures the debt, waits for the economy to recover, and then sells that same company for $120 million. It's the same company, in the same market, just with different timing. For these firms, economic collapses aren't unfortunate accidents. They are the essential entry points for their entire strategy. The fifth group is the asset accumulators, people who focus on real estate, gold, and other hard assets. When faith in paper currency begins to weaken, smart money instinctively moves from promises to things. Land doesn't disappear in a puff of smoke. Gold doesn't default on its debt. A piece of critical infrastructure doesn't go bankrupt. During collapses, you see a predictable flight to quality. You see real estate buying sprees. You see a surge in gold accumulation. You see a grab for energy and commodity control. This isn't because these assets grow incredibly fast. It's because they survive. They are a hedge against inflation and chaos. When people lose trust in their currency, real ownership becomes the ultimate form of protection. Now for a more uncomfortable truth. The sixth group that benefits is governments and political insiders. During any crisis, governments gain power. They expand their control over the economy and daily life. They issue emergency rules and regulations. And most importantly, they decide who gets rescued and who doesn't. And those who are close to the circles of power, government, contractors, connected corporations, political insiders often benefit immensely. Bailouts are rarely random acts of kindness. They follow the lines of influence and power. An economic collapse has the predictable effect of shifting power upward, toward the state, not downward, toward the people. And finally, we have the seventh and most important group, and also the smallest. These are the people who understand the system, not just how to work hard within it. These are the people who have taken the time to understand debt cycles, the mechanics of inflation, how assets are truly priced, and most importantly, human psychology during periods of intense fear. They don't have a crystal ball to predict crashes perfectly. They don't need one. They prepare structurally. They minimize their exposure to bad debt. They build up liquidity when times are good. They focus on acquiring assets, not just earning income. And so, when panic inevitably hits the market, they don't freeze. They act decisively. So, why do most people lose? Let's be honest about it. Most people get wiped out during collapses for three simple reasons. They are over-leveraged with debt. They depend entirely on a single source of income, and they sell their assets at the absolute worst possible moment. They play defense emotionally instead of playing offense strategically. Fear is a powerful motivator, and it makes people liquidate their life savings right before the recovery begins. And that is the real tragedy of it all. Here's the hidden truth about economic collapse that nobody likes to talk about. These events are not failures of the system, they are features of it. They function to reset prices, to transfer ownership, and to concentrate wealth into fewer and fewer hands. The system doesn't break. It rebounds as always in favor of those who understand how it works. So what should you learn from all of this? You don't need to be a billionaire. You don't need to have insider access. But you absolutely must stop thinking like a consumer and start thinking like an owner. Start asking yourself the right questions. What assets survive chaos? What kinds of debt destroy your freedom? And what skills give you leverage in a world of uncertainty? Because when the next collapse comes, and make no mistake, it will come, the question isn't whether money will disappear. The only question that matters is, whose hands will it end up in? That's the real game. And once you see it, you can't unsee it. Thanks for watching. If you found this valuable, make sure to like and subscribe for more content that helps you understand the rules of the game. See you next time.